I'm Josh Richardson from PwC and part of the organizing committee for today's conference and tomorrow's conference. And I have the pleasure of introducing our opening conference today, brought to us by Economic Partners, a Ryan company, where they're going to be talking about transfer pricing insurance. So without further ado, I wanted to turn it over to Perry Urken from Economic Partners. Go ahead, Perry.
Thanks very much, Josh. And we're delighted to be able to have the opportunity to speak before this conference on this topic. So I'm a principal with Economics Partners based in Washington, D.C., and my two colleagues, also principals with Economics Partners, Rodrigo, Fernandez, and Vincent, are co-presenting with me today. For those that are not familiar with our firm, EP is a group of approximately 40 economists that specialize in transfer pricing, controversy support, planning, and compliance. And our principals are involved in many of the most high-profile, largest transfer pricing controversies in the U.S. market, as well as a number of controversies overseas. Over the past year, we've been working to develop a specialty arm of EP that will, in conjunction with some high-profile partners in the insurance space, work to broker and underwrite transfer pricing insurance policies. And we thought that transfer pricing insurance would be an interesting topic for our panel. And in the following slides, what we'll try to do is provide some general background on what transfer pricing insurance is, the key parameters and other elements of policies, as well as a discussion about pricing of the policies. If we can move to slide number 2, there's a definition of transfer pricing insurance on the slide. And basically, if a company has a tax due that is dependent on the pricing of an intercompany transaction, and if that company is uncertain regarding the resolution of the pricing of that transaction upon audit by a tax authority, then a transfer pricing insurance can serve as a mechanism, a contractual mechanism, to transfer some portion of the uncertainty surrounding the potential costs related to the transfer price to an insurer. And we can go to slide number 3, please. In this slide, we have a kind of a summary of some of the key parameters of transfer pricing insurance policies. And the first and most important is the specification of what transaction is being covered. So for example, transfer pricing insurance can provide a risk transfer with respect to a intercompany royalty with an affiliate, a tangible goods transaction, intercompany services, or sale of intellectual property. But the first step is to specify what transfer price is being covered. And another important element is the time period that's covered for the transaction. So certain transactions that are one-time in nature, like a transfer, a sale of IP, may not be so much of an issue. But for recurring transactions, like if there's a royalty that's paid every year, if there are ongoing purchases of property, the policy should define what time period is covered by the policy in terms of the transactions that are included. The next element that's important is what costs associated with the subject transfer price are covered under the policy. So generally, the most important cost is the income taxes that are imposed by a tax authority given the pricing of an intercompany transaction. But there are other costs too that which can also be covered at the discretion of the parties. Interest and penalties associated with the tax liability, costs that are incurred by advisors to pursue the case in a controversy with the tax authority, and then because claims are generally taxable if paid out of from a given a policy, the cost of the tax cost due on those claims are generally grossed up as a part of the covered cost in the transfer pricing insurance. And then the last two points, which there's a graph where I'll go over these two again, but in a way that I think is more clear. But just to introduce these terms, a policy limit is defined as the maximum amount that an insurer will pay out under a transfer pricing insurance policy. So it's a sort of the cap of their total potential payments to the insured, and that will be defined in the policy. The last bullet here, the attachment point, what that means is the transfer pricing outcome in terms of the price that at which the policy coverage kicks in. And as I'll explain in a minute, that's a means of varying the attachment point is a means of sharing the risk between the insurance company and the taxpayer. If we can go to slide 4, please. So we're going to use a hypothetical example here to try to illustrate some of the considerations with respect to transfer pricing insurance. So in this hypothetical example, we have a US taxpayer paying an outbound royalty to an affiliate for use of a trademark. And we're assuming that that affiliate is in a tax jurisdiction with a lower tax rate than the US for purposes of the example. And we also assume that the taxpayer perceives some risk that upon audit, the IRS may disagree with the transfer price and adjust it to a lower amount, and that there'll be some back and forth about what the appropriate transfer price is, and that's uncertain in terms of how that is going to be resolved. And so, in this situation, a transfer pricing insurance policy can be one means of addressing this risk associated with the royalty. And could we go to slide 5, please? So this gives a little bit more detail about this hypothetical example, and what the top portion of the table shows the potential outcomes given different resolutions in terms of the royalty upon audit. And then at the bottom, we depict at a high level 2 different alternative transfer pricing insurance policies that could be applied. The return position in the far right of the slide is shown is the $100 royalty that's paid by the taxpayer. That's what's on their tax return in this example. And so the first row shows the royalty, and the second shows the incremental costs given an adjustment. And so in the scenario where the resolution is the same $100 that the taxpayer paid on their, that's reflected on their tax return, there's no incremental cost because there's no adjustment. On the opposite end of the spectrum, on the far left of the table, it's labeled worst case scenario. That's intended to depict a situation where the tax authority disallows the entire royalty, and so the royalty is adjusted from 100 to 0. In that situation, given our assumption that there's the incremental cost to the taxpayer is 20% of an adjustment for purposes of this, again, for purposes of this example. The incremental cost in that scenario is $20 because the adjustment would be 100, going from 100 to 0, and 20% of that is $20. There are a variety of other alternatives in between, including what's labeled as the expected outcome. The inference here is that perhaps the taxpayer was aggressive in terms of pricing the royalty, and they recognize that, but that in the back of their minds, they're expecting that the quote unquote right answer is closer to $70 royalty, and so that might be in this example the expected outcome upon a principled discussion with an adverse party. And so policy A and policy B are labeled below. Again, these are 2 different potential ways of structuring a transfer pricing insurance policy as differentiated by the 2 factors I mentioned before, the limit, the policy limit, and the attachment point. So in policy A, we have a situation where the policy limit for policy A is all the way at the worst case scenario, and the attachment point is the return position. So that means that if there's any adjustment at all between, and the outcome is between 0 and 100, the insurance policy will cover that and pay the corresponding cost. So, for example, if upon audit the royalty is reduced from $100 to zero, there'll be a $20 cost that's incurred, and that cost will be subject to an insurance claim under the policy. In policy B, it's a bit different, where the covered risk is more limited, and here the limit is not defined as the worst case scenario. It's defined as a $20 royalty. That's the lowest outcome that will be covered by the insurance policy. Whereas the attachment point is also different, and that's set at what was referred to before as the expected outcome of $70. So what that means is that if the client entered into policy B, and there was an adjustment down to $0 as a result of the audit, the insurer would not be responsible for the entire $20 of cost. They would only be responsible for $16 of cost, because that would be the limit set on the policy. In addition, if the adjustment went from $100 to $90 under policy B, that would not be covered. There would be no claim due, because that portion of the risk is not part of the covered risk under the policy. So again, this is intended to kind of show how the definition of the limit and the attachment point can be used to modify and specify the covered risk that a client would like in terms of the policy.
Yeah, Perry, why would a company interested in TP insurance agree to a policy attachment point lower than their return position? For example, here, policy B in this example.
Sure. So in a perfect world, all risk would be covered in this type of policy, but the higher the risk, the higher the cost. And so there's a trade-off. The larger or the more significant the risk, the higher the premium is going to be for the policy. And so there's a trade-off. There's a trade-off in terms of what type of risk, as a client or a taxpayer, what type of risk am I okay with retaining in myself? And the more risk I'm willing to retain myself, the lower the premium will be for the policy. And so that's something that is an important part of the structuring of the policy that the client and its advisors go through prior to entering into the discussions with the insurer.
It's the sharing of the risk initially in the introduction.
Exactly. Can we move to this slide gives a very high-level overview of the transfer pricing insurance market today. And transfer pricing insurance is a subset of tax insurance, which is a much broader area in terms of the insurance market. And tax insurance has been growing quite rapidly over the past few years. And there's a number of different types of tax liabilities that can be insured. Transfer pricing insurance is something that is still in an earlier stage of development than other areas of tax with respect to the insurance market. But there are a number of transfer pricing insurance policies that have been entered into. My understanding is that most of them have been in Europe, and that most of them are in conjunction with M&A deals. So, for example, a buyer may be considering a target, but they're worried about a given transfer price or a given tax or other tax liability, and so they will enter into a policy that covers them in case that risk can't be addressed otherwise with the seller through a indemnity or other such arrangement. Another possibility is that sellers are more proactive and they are worried about the impact that a transfer pricing liability has on the sale price of their firm, and to address that, they enter into a policy which removes that risk from the enterprise being sold contractually. The other type of situation where transfer pricing insurance can be employed is what's called on this worksheet organic transfer pricing risk. What that means is that it's a transfer price that within a multinational is self-developed due to a policy that it put in place in itself, as opposed to one which is has been put into place by a third party that they're considering acquiring. So it's a way of managing your own internal risk. That's the basic difference between what we're calling organic transfer pricing risk and ones that arise in M&A transactions.
So Perry, on that point, I mean, I certainly see, and I have seen a number of my clients that have, acquired riskier TP policies or transactions through an M&A deal, and I totally understand the point on the sale point as well. But with respect to organic TP risk, I guess the question around that is, what types of organic TP policies would be suitable for this? We talked about the royalty example in the preceding slide, but what types of policies and what types of risks are these? Just jurisdiction specific risks with respect to the transacting parties, risks related to maybe OECD, BEPS concepts, things like that, or what are your thoughts there?
So we're involved with a couple of different clients who are interested in pursuing transfer pricing insurance policies that are organic as defined above. Or in the slide. And what we see is generally that the threshold for the level of risk that is worthy of insurance is higher for organic transfer pricing risk than it is for an M&A situation. I think that there are relatively, I'd say, relatively less complex transactions that are insured in M&A deals than I think would be considered, from what I've seen so far, in organic situations. So what we see is risks that really matter to the company, that there's a reserve for example, or that impose a potential outcome of a large outflow of tax. Those are the ones that seem to be most interesting from a client perspective right now. Okay, can we move to slide 7, please? So in terms of the process for how any tax insurance policy is entered into, but also a transfer pricing insurance policy, this slide outlines the basic steps. And basically the framework is that because these are bespoke transactions, if a client wants insurance, they can't simply just call a 1-800 number and find someone to give it to them. They generally need to employ a broker, insurance broker who specializes in the tax area. And with transfer pricing insurance, there will also be an advisor involved who specializes in transfer pricing, and that's how we're involved in these situations. And so what the brokers do is to present the tax risk to an insurer in a manner which they're likely to, or they're as likely as possible to agree to finance the risk and cover it. So what that means is that they in conjunction with, there's a lot of conversations with the client and the advisor, but after this picture is put together, the broker explains the risk to the market, to the insurance market. They present the proposed pricing and the proposed contractual terms, and they try to show that the pricing makes sense with respect to the level of the risk that is borne by the insurer under the proposed deal. And so what happens is that once that kind of presentation is put together, the broker will go out to its contacts among the insurers who specialize in the tax space, and they then assuming that the insurer is interested, there'll be a negotiation, and they'll go back and forth in terms of what might make sense in terms of pricing and such. as part of that, the insurer will have its own experts and will underwrite the policy, and then based on its findings from underwriting, we'll come back to the broker again, and they'll re-engage and hopefully negotiate a final policy. And again, for transfer pricing, that's the general process that's employed for tax insurance. For transfer pricing insurance, it's aligned with that. However, there's a bigger role for transfer pricing experts because they're obviously central to quantifying the risk and pricing the risk.
Yeah, Perry. So, I would be interested in avoiding a future cost based on some transfer pricing risk, which you've outlined here in the examples above. But at what point during this process do clients have to pay fees?
Sure. So this could vary depending upon the arrangement between the broker, advisor, and the client. But in the situations that we've been involved with, the way that it's worked is that the initial consultation, the discussions with the broker, the work with the broker to develop that story, that presentation of the risk, and the initial marketing of the risk to the insurers, that's the client doesn't pay any fees for any of that. The first fee that the client pays is when the broker, when the insurance company says, "Okay, I'm interested. To do this, we need to underwrite it," and then there's a moderate underwriting fee that's paid by the client if they want to go forward. Then once that, but until that point, there's at least in the way that we manage this, there are no costs for the client. And then again, once the underwriting is done and the policy is agreed to, then the premium is paid at that point. So that's how that works. If we can move to slide 8, please. So this slide lists a couple of other considerations that are relevant to transfer pricing insurance. And the first is duty to mitigate. What that means is that if I'm a if I'm a client and if I'm a taxpayer and I enter into a transfer pricing insurance policy, I can't just sit back and decide, well, I don't need to worry about this anymore. I'm not gonna engage with the IRS on audit. I'm not gonna put my best foot forward in terms of defending my position. These policies will require the taxpayer to mitigate the risk to the best extent that they can, and so that's something that is an important part of these policies. On a related note, because the insurer owns a portion of the risk, they generally have the right to participate in some manner in controversy proceedings. So if an insured transaction is an audit, generally the insurer will have the right to be kind of updated on the progress of the audit and any main milestones. And oftentimes they will also have the right to veto a settlement if depending on the impact on the insurance policy of the settlement agreement. Offsetting benefits may come into play in situations where, let's say there's a transfer price and there's an adjustment, and that adjustment results in increased income tax in the U.S. There may also be corresponding impacts of that adjustment on, for example, GILTI or other portions of the code. And that's something that's worth considering in terms of both pricing of the insurance and also just assessing the overall willingness of the client to pay a given premium. Competent authority is also something to consider. If whether or not there is competent authority relief available to mitigate a given transfer pricing risk is something that's worth considering, certainly. And then we talked about this already, but the portion of the risk that's retained by the taxpayer as opposed to transferred to the insurer is something that is a central part of the development of these policies. And it's not just through the attachment point that can be achieved, but that's one mechanism. But there are other contractual means of sharing risk, even if something as simple as a deductible. But that's a critical part of any transfer pricing insurance policy.
So when we think through the considerations here, am I correct in thinking about transactions that involve parties that have treaty partner jurisdictions, that TP insurance likely would not make sense given the availability of MAP and competent authority or resolution through an APA, something like that? Is that the right way to think about it?
Well, I think it depends, and that may be the case. I mean, it may be the case that if you have a transaction between parties that are in jurisdictions where with treaty partners, transfer pricing insurance might not be as obvious of a means to address your transfer pricing risk as it might be otherwise. However, I think it really depends on two main things. One is the client's willingness to pursue competent authority. It's a long process, and it's a bit of a black box at times, and you're going to incur some fees to likely for advisors to pursue that. The other is to what extent there's a tax differential between the two parties that are subject to the transaction. So you might care about what the outcome is, and in that situation, I would think that competent authority wouldn't necessarily be the best way to lock in your desired outcome. So I think in some cases, even when competent authority is an avenue to pursue, and it may not preclude you from deciding, well, I still think transfer pricing insurance is something worth exploring. And, ultimately it will come down to cost, right? If the premium is really, really high, then maybe you're more willing to fall back on competent authority. But if the premium is a bit lower, then maybe it becomes a more viable, viable alternative. Okay, can we go to slide 9, please? So the next 2 slides cover pricing and how we think about pricing of transfer pricing insurance policies. And some risks that are covered by tax insurance are a bit more simple to price because they're binary, they're black or white. Either it's debt or equity, it can't be in the middle. Whereas transfer pricing is certainly not binary in almost all cases. And transfer pricing, there are a multitude of potential outcomes, and that makes it more complex in terms of a risk to cover through an insurance policy. And so, because of this, the starting point of any pricing exercise for a transfer pricing insurance policy is the assessment of what can be called sort of the probability adjusted outcome, or the most likely outcome. And if you remember back in the example slide, that was one of the points that was highlighted, and it becomes an important basis for the pricing of the policy. And I think to some extent, this concept, the concept of the most likely outcome under a situation where there's multiple alternative outcomes for a transfer price, is something that companies have been dealing with for a long time for FIN 48 purposes. So for FIN 48, companies are required to establish scenarios and assess relatively likely probabilities, and for purposes of establishing the reserve for certain transactions, for certain intercompany transactions. And for that reason, a lot of times we're able to use a company's FIN 48 work papers as a good starting point for assessing the most likely outcome for a covered transfer price. And but what will be done is that there'll be some dialogue, there'll be some back and forth in terms of understanding the company's position, the FIN 48 position, obtaining documentation which will show kind of the company's methodology presented in in their transfer pricing studies and other work papers to understand why they ended up where they did in their FIN 48 analysis and their assessment of the probabilities. But then, we or other advisors and other underwriters will go back and say, okay, well, this is what the company thinks, but we have experience with this transaction and audit, and we think that perhaps their assessment of the relative probabilities is not is overly optimistic, or we might draw on different types of expertise to assess what the likely outcome of a certain transaction is at different phases of controversy, whether it be appeals or audit or what have you. And so there will be an independent assessment of the most likely outcome using the company's position as a starting point. But in essence, the first step is to establish our view, or the underwriter's view, or when we're acting as a broker, our assumption as to the likely view of an underwriter as to what the most likely outcome is. And then once that's done, what we've tried to do in policies we're working on is to, once we assess the probability weighted outcome as a first step, the second step is to map the main factors, the main drivers, which may differentiate the company's tax position and the potential position of the IRS. And what we will do then is we'll kind of triangulate the most likely outcome, the drivers that might move the answer in terms of where the issue will end up on audit, and the attachment point. So in a lot of times what we'll try to do is we'll try to position the attachment point at a point along that range of outcomes as determined by the due diligence to assess the appropriate price, and also to help tell the story I was referring to before of why this risk might make sense for an insurer. So this is the most important step in terms of the pricing process, is the evaluation of the risk from a transfer pricing perspective. And if you could please go to slide 10. This is the last slide. When insurers and brokers quote policies in generally, but especially in the tax insurance space, they're generally quoted as a percentage of the policy limit. And if you recall, we talked about the policy limit before. The policy limit is the maximum cost that the insurer will pay out in the event of a claim. And so the premium is presented generally as a percentage of the limit for a given policy. And just based on our review of public statements in terms of premiums paid in the tax insurance space that are publicly available online, we see rates, as well as discussions with some of our partners that we're working with. We see rates that are generally between close to 2% to 8% of limits. So that means that if the limit is $1,000, that's the most that we paid out in terms of for a transfer pricing insurance policy. That means that it'll be $25 to $80 will be the premium for the policy in general. However, there are a variety of factors that will influence premium pricing, and so that's a fairly broad range. But there are a number of reasons for different pricing for different types of policies. And on this slide, we list a couple of the main factors. I think the most important factors are likely the attachment point and the strength of support that the company provides for its position. So you can imagine on the latter point, you can imagine one scenario where a client has robust documentation that's very well and clearly presented that supports its transfer pricing position. It provides all the information that the insurer needs to assess the risk. It's responsive in terms of questions that the insurer asks. In that situation, that will and assuming that all those documents present a compelling rationale for the company's position, that's going to, all else equal, lead to a lower premium because that helps to mitigate the risk. The other, as we went over before in the example, the attachment point is another important driver of the premium, because if the attachment point is set such that the covered risk is very large, then all else equal, that's going to result in a higher premium, as opposed to a situation where the attachment point is set so that the taxpayer retains some of the risk. That means that the amount they'll have to pay for the transfer risk will be lower, obviously, because there's a lower amount of transferred risk to the insurer as a result of the setting of the attachment point. So those are generally the most important, but there are a number of other factors, including the policy limit. Obviously, the higher the worst case scenario from the insurer's perspective, the more they'll expect in terms of compensation for their risk. There's also the question of the jurisdiction of the tax risk. There's some markets that are more uncertain than others. For example, if you got transfer pricing insurance for a controversy in India, it might be more expensive than an analogous policy for TP risk in the U.S. Because of the uncertainty of that market historically. And then there are other more kind of nuts and bolts type factors, like whether or not the covered costs include things like advisor fees. Obviously, if you do include some of those other costs in the pool of expenses that are reimbursable under the policy, the cost of obtaining the policy will go up. And then we already went over the underwriting fees, which are generally moderate fees, but they do vary based on how complex the transfer price is. So that's really all we have in terms of the presentation. I think this is a field that is growing and it's emerging. Part of the significant growth of the tax insurance market to date, and it's a pretty interesting opportunity for companies, we think, to consider as means to manage certain types of transfer pricing risk. I don't know if we have any questions or anything from the audience, but we're certainly happy to take those if there are any. Okay, we answered all the questions. That's good. Okay, well, thank you very much for everyone's time. We really do appreciate it. Thank you.
Perry, thank you so much for this really great presentation. Really appreciate you guys putting this together. Really learned a lot.